Hello everybody, welcome to Ask a Fund Manager. This week I'm going to talk about zombie companies. What zombie companies are, why they matter, and what does it mean for future investing decisions. The most common definition for a zombie company is a company that is heavily indebted and it generates enough cash to cover its basic expenses such as wages, rents, uh, manufacturing costs, etc., and can cover its interest payments, but it does not have enough cash to eventually pay off the principal on its debt. And then there's a more strict definition, which is that zombie companies are companies that cannot pay their interest if interest rates ever go above 0%. And combined, both of these definitions of zombies are growing quite quickly. This used to just be a phenomenon that was limited to banking companies and non-competitive manufacturers in Japan. But after the great financial crisis, particularly in Europe, zombie companies grew not just among the banking sector, and you could see this as what's happened with the stock chart of European banks since 2010, but you're across European companies broadly, and that's why the banks are in trouble, because a lot of the companies that they're lending to are insolvent without extremely favorable interest rates. And then and more recently, say in the last 3 to 4 years, this zombie phenomenon has started to take place in the United States as well. In the U.S., it's mainly driven by having such a long period of rates at zero from 2008 to 2015, and then just only one rate hike until the beginning of 2017. And then now we're back at zero starting as March of this year. Companies have gotten used to extremely low interest rates. And because of that, they decide to borrow as much as they can to buy back shares and or to expand otherwise something that would be not financially viable to do. But it's more in larger companies for share buybacks that their balance sheet is so heavily levered that if the principal ever came due or if interest rates ever rose, that there's a good chance that the companies would go broke. It's also preserving a lot of other companies that in a normal market environment would not be competitive. They would have gone out of business due to interest expense. But with interest rates at historic lows, interest expense is next to nothing. In fact, it's negative for a lot of heavily indebted companies in Europe, for example, that these companies survive where they wouldn't otherwise. So what does this mean for the economy, and what does this mean for markets? Well, just from a first view, I think a first level view, the idea of zombies is actually seem to be the best shorting opportunities. I mean, they have a heavy amount of debt. They don't have the cash flow to cover it, especially if interest rates go up. And the reason a lot of the times that they've racked up all this debt because they were not competitive or they made poor financial engineering decisions. In a all things equal environment, these would be the best short selling opportunities, and a lot of them have turned out to be good short selling opportunities. But the problem is when you have a central bank, which is an extension of a culture, which fundamentally believes that nobody has a right to fail, or that the jobs lost by these zombie companies failing would be so catastrophic to the system that they will get bailed out. I mean, this is part of the reason why you've seen the Fed start to interfere in the junk bond market, and also why you've seen ECB buy corporate bonds. It's just that it's not just that banks are now only too big to fail. It's basically any company with enough corporate bonds listed in the market or big enough of a market cap that or hires more than a certain amount of employees has no right to fail just because of the systemic consequences. Economically, this is not going to lead to good results. I mean, it's going to lead to stagnation because newer upstart companies who can compete in this environment without a lot of debt can't grow because you have these companies, zombie companies, are able to produce their product at what is an uneconomic price point and still survive. This may have some impacts on in the inflation debate, zombie companies may help cause more deflation. So the reason I just mentioned is just the fact that it has a lot of, it, on the other side, it creates a lot of competition among large multinational companies that otherwise wouldn't exist, and therefore that supply of goods and services would not be on the market. I kind of disagree with that because I think there would just be more better run companies who would fill the void, just like any other ecosystem. If a certain block of the food chain dies off, something else will come and fill that niche and expand its population quickly. And I think it would be the same in the business world. So you have that point. It's just you have the impact on labor force. It's creating a lot of people who are working in suboptimal levels of productivity, not for any fault of their own, just because of the fact that their business is structurally a zombie. And so that's part of the reason why I think you've seen productivity numbers fall across developed economies and in countries that pursue bailing out zombie companies. So, and then also it prevents the society from ever being able to handle a hike in interest rates. And this may be the reason why we never see interest rates, in real terms at least, rise ever again. The last time we had positive real rates for an extended period of time, it wasn't even that long, it was less than a year, was in middle of 2018. And then at the end of 2018, we had a 20% crash in the equity market on just growth fears from the fact of zombie companies being choked by higher interest rates. And because of this nature, that you're going to have an economy that cannot grow without perpetually falling interest rates, and real interest rates getting more and more negative over time. I mean, what the question is, what's the way out? I mean, there is inflation, but inflation is not broad-based, and some companies will be able to pass on their cost to consumers easier than others. And the zombie companies who can't will be in trouble because interest rates will go up nominally, may at a slower pace than inflation, but still, so they may be lower real, but they'll go up nominally, but the cost structure of the zombie company may not match the general inflation profile of the economy. And so that's maybe where things come to a head of itself with zombie companies. But I think it's going to cause a systemic issue. I thought we were going to see that in March with the pandemic, but now with the Fed coming in and buying, or at least promising to buy, high yield bonds and corporate bonds generally, they may have pushed this down the road a little bit. Overall, I just think that there still will be excellent shorting opportunities among zombie companies, and I go into more specific that just with among my clients. But you just have to be more careful with timing, because there always is that risk of a backstop, and managing risk is critical if you're going to short at all, but especially zombie companies, because if real rates fall, zombie companies will be the best performers. In fact, if you look at the performance of zombie companies versus the broad indexes, they've outperformed on this way up because the fact that lower interest rates increases their probability of survival. And this, in terms of how widespread zombie banks are, the numbers I could find are based off of reports from Deutsche Bank, and they're about 19% of companies in the U.S. and 15% in Germany. I don't have numbers for the rest of Europe and Japan, but I figured it's higher than both of those because the U.S. and Germany are two of the best performing developed market economies in the world. And among even like just major indexes, you have 38% of the Russell 2000 is unprofitable. I mean, a lot of that is due to biotechs. So on a biotech adjusted basis, it's much lower than that. But still, you have a significantly high percentage of companies that are unprofitable, more so in the past. And you have more zombie companies particularly that can't cover their interest expense. It's could be as high as 19% of the S&P 500. So that's my commentary on zombies. If you have any questions about zombie banks or really anything else in the markets, feel free to leave a comment in this video or email us at askafundmanager@gmail.com. Let me know if you have any questions, and good luck out there in the markets. Just as a disclosure though, anything that I talk about in this video is just for educational purposes only. Talk to your financial advisors and do your own homework before making any trades. Have a good rest of your week in the markets.